Today, we are going to be starting a new topic, moving forward from where we started from last week. Remember, last week, Monday, we looked at regulatory framework, which I told you is 5% of your syllabus. Today, we'll move to topic 2, which is conceptual framework. And last week, looking at the chapter 1 of this text, I first of all made you understand what corporate reporting entails. And I told you that corporate reporting majorly wants you to have the competence of preparation and presentation of an annual report, And don't mistake an annual report for a financial statement. The financial statement is within the annual report. There are other information in an annual report beyond just the financial statement. So for corporate reporting, we are going to be learning a lot about financial statements because we are going to be learning a lot of accounting standards, as well as all those other information beyond the financial statements that are contained in an annual report. Then we mentioned that an annual report for many countries or for many companies in a lot of countries are very similar because they have a similar regulatory framework. Then that took us to an understanding of what regulatory framework is. And in learning about regulatory framework, I told you that for regulatory framework, we were going to look at first the regulations, which are the rules and principles that governs reporting, as well as the regulatory bodies that develops these rules and principles. Everything I explained to you last week was around these two areas: the regulation, which is the rules and principles, and the regulatory bodies that develop these rules and principles. I explained the rules and principles. I told you firstly that they are called GAAP, Generally Accepted Accounting Principles. And immediately I told you there are 3 sources of GAAP: the company law, the accounting standard, and the local stock exchange listing requirements. The accounting standard is obviously a rule and principle that governs reporting because they are authoritative statements that explain to us how transactions and events are treated. And we're going to spend a lot of our time in this class learning about accounting standards. For company law, the examples of company law we have in Nigeria are CAMA, Companies and Allied Matters Act of 2020. There's the BOFIA, and there's the tax law. The company law is also a gap because it also have an input into the report. I explained that to you rigorously last week, and as well as the local stock exchange listing requirements. In Nigeria, I told you that our regulatory framework in Nigeria is a mix of rule-based framework and principle-based framework. It's a mixture of it. And this mix is arising because our accounting standard, which is IFRS, is principle-based. But the company law and the local stock exchange listing requirements are rule-based. So our GAAP, our regulatory framework, is a mix of rule and principle. We went on to the regulatory bodies, And I told you that the regulatory body in charge of these regulations, which is the IFRS to be specific now, in Nigeria is the Financial Reporting Council of Nigeria. And I told you that this Financial Reporting Council of Nigeria has one important objective, which is to protect the interest of investors and other stakeholders. And I told you that they have other objectives, but their other objective is towards achieving that their first objective of protecting the interest of investors and other stakeholders. And those other objectives like providing guidance on issues relating to financial reporting and corporate governance, like ensuring companies adopt or use the right corporate governance practices, to ensuring that companies' financial report is accurate and reliable, to ensure that there's high quality of service among professionals and all of that. And I went ahead to tell you that this objective of the FRCN, it is our responsibility as professionals, as accountants, to ensure they also meet it. Because in meeting the objective, all accountants, all professionals are expected to have an FRCN number. Like when you guys qualify, you are required to get an FRCN number, because without this FRCN number, you cannot sign an annual report. You cannot sign it. You should not sign it. And it will be an ethical issue if you go ahead and sign without an FRCN number, because you are even required to quote it below your name when you sign an annual report. Additionally, any professional like lawyers, like valuers, like actuaries who help us to value defined benefit plans, all of these professionals, we need to ensure that they have an FRCN number before they can have an input into our financial report. If you allow them or if you use their figures in our annual report and they don't have an FRCN number, it's an ethical issue. It is an ethical issue. And also, the FRCN, in ensuring that professionals have high quality of service, that audit firms are doing the right thing, that companies have good corporate governance practices in place, they usually go for regular audit, just like the way FRS goes out for tax audit. They also go out for audit. So when it comes to your entity and you don't allow them enter to exercise or do their audit, that is also an ethical issue. And you know, ethical issues are punishable. Is that they penalize you or any other way they want to punish such company or professional that err on any of these issues. Furthermore, I made a very important point last week. I told you that it is not the FRCN, the Financial Reporting Council of Nigeria, that develops the IFRS. I told you there is a body, there are bodies behind the IFRS. What the FRCN did in 2011 was to adopt the IFRS. They adopted it. Then we then looked at, okay, who are the bodies behind the IFRS? I told you that these bodies behind the IFRS, they call them the IFRS foundation structure. And this structure is a three-tier structure. Three-tier meaning that there are three levels of authority in that structure. The first level, we call them the monitoring board. And this monitoring board consists of capital market authorities. And these capital market authorities are regulators of the stock market in their respective countries. This monitoring board then appoints the IFRS Foundation. And the members of this IFRS Foundation, they call them trustees. So we can put them as IFRS Foundation trustees. These trustees are the engine of this structure because they are the one that have the vision of this structure. When they were created with 4 objectives. I told you last week. And number 1 is that we want to develop a single global high quality accounting standard in public interest. Meaning that when they were created, their aim is that they want just one accounting standard that will be used by all companies all over the world. So their second objective was to promote the use and rigorous application of these IFRS. Number 3 is to take care of the need of small and medium enterprises and emerging economies. And number 4 is to harmonize international and national regulations. The IFRS Foundation delegated this objective to the 3rd tier. Who are the standard setting bodies? There are 2 of them. There is the IASB and the ISSB. The IASB focus on development of IFRS. The IFRS Foundation has delegated that duty to the IASB. The ISSB focus on developing IFRS sustainability disclosure standards. I'll teach you a little bit about sustainability reporting, and we'll talk about IFRS S1 and IFRS S2. And other discussions we had last week. And finally, we ended the class by looking at how is IFRS developed, the process of developing IFRS. We explained it that the process is an open, inclusive, and transparent due process, where they ensure that the best thinkers is involved in the process of developing IFRS. They engage everyone. And I told you there are 4 steps. Step 1 is the agenda consultation, where they develop a work plan. Step 2 is the research phase, where they come up with a discussion paper. Step 3 is the standard setting phase, where they come up with a proposal for accounting standard called exposure draft that ends up being the IFRS. And step 4 is the implementation phase, where they carry out post-implementation review. And I gave you 2 assignments to research on. Number 1, I told you to look into the advantages and disadvantages of rule-based framework and principle-based framework. Yeah, I told you where I belong, my own school of thought. I wanted you to research so that in your mind, you can create which one do you feel is best. Secondly, I told you to research on the reasons why regulation is necessary in Nigeria, why regulation of reporting is necessary in Nigeria. I want to believe that those in class have done it. Even those of you not in class, I'm sure we have all been added to our groups, and we have shared the videos of this class. I want to believe we have looked at it, and the note also, you have access to all the materials for this class. Okay, so that was what we did last week. Today, we are moving to another 5% part of your syllabus. And this is called Conceptual Framework, which is the chapter 2 of these tests. Remember, I told you that IFRS is principle-based, which means that IFRS is itself developed from set of principles. So those set of principles from which IFRS is developed from, those principles on which IFRS itself is based, is the conceptual framework. So what we want to learn tonight are the set of principles and guidelines that actually underpins the preparation and presentation of financial statement. So the key thing here is the set of principles. I've been shouting principles. So conceptual framework we want to learn tonight are the set of principles on which the IFRS itself is based, those principles. So I can simply put it as that the conceptual framework provides the basis for the development of new accounting standard and for the evaluation of those already in existence. Therefore, the conceptual framework is the tool, is what provides the basis for developing accounting standard. They are the principles that are used to develop accounting standard. In fact, some people say that this conceptual framework is the source or the foundation of reporting. And they are not wrong. Because since it is the set of principles on which IFRS is based, on which IFRS is developed, so it's the foundation. And don't forget that the IFRS is the authoritative statement that guides how transactions are treated. Now we are saying those authoritative statements, those set of principles, this is where they originate from. These are those set of principles. Now, from the introduction of conceptual framework being the set of principles on which the IFRS is based, on which the IFRS is developed, then we cannot argue that this conceptual framework has certain key advantages. And the very first that is obvious is, let me call it standardization. Standardization in the sense that the process of developing accounting standard will become standardized and coherent. That means we'll have a uniform way in which all standards will be developed, since they are based on the same principles anyways, since the conceptual framework is the principle from which standards are developed. So it gives us the advantage of standardization because we already know the principle. We just follow the process, right? So it makes the process of developing standardized and coherent. Additionally, still speaking about standardization, this conceptual framework will now enable all IFRS, all accounting standard to have the same structure. They will be structured the same way because it's the same principle. They will be structured the same. So that is why when you check a standard like IS 16, for example, now, when you understand IS 16 properly, you will see that all other standards on assets that are asset related, they have almost the same recognition and measurement basis. All standard on non-monetary asset or non-financial asset, the same. The reason is because they are based on the same principles. So their recognition and measurement bases are extremely similar. The only differences will just be their peculiarity, the nature of the item. That is just the only thing that would be different. The second one is the issue of political interference in the process of developing standards will not even arise. It will not occur because we have the principles that we use in developing our standard. So politicians cannot come and interfere in the process by which we develop our standard. Politicians cannot tell the FRCN, for example, that they should make companies value all their PPE at fair value. If politicians feel that they would benefit from that in terms of the market capitalization of the nation, that can't work. They can't tell us how we should develop standards because of this conceptual framework. So it will not be subject to political interference. Number three is that users and preparers of financial statements will understand that accounting practices and accounting standards are based on common ideology. Common ideology as in the set of principles, because we have this uniform set of principles on which IFRS is developed. So users understand that we're not just doing what we do anyhow. Our reports are not done anyhow. It's based on a common ideology. Number four, it provides guidance for unusual transactions. It's not uncommon that there would be transactions that we have not seen before, that there will be new transactions on which we don't know how to treat them, that we don't have an IFRS for. Like during the time where cryptocurrency just came up and companies started buying into it, a lot of accountants didn't know how to treat it because it's an unusual transaction. It's not something we're used to, digital asset, right? However, over time, the IFRS Interpretation Committee came up with an interpretation and they taught us how to treat it. And their ability to come up with an interpretation was based on their understanding of the conceptual framework. They used the conceptual framework to develop that guidance, that interpretation. So the fourth objective of this conceptual framework is that it provides guidance for unusual transaction. So those are the advantages of the conceptual framework. The disadvantages, the very first is that financial statements is intended for many users with diverse requirements. So it's not certain that a single conceptual framework can be devised which will suit all users. I mean, we need to understand that the conceptual framework or IFRS, as the case may be, let's be specific to IFRS, is used by many countries and many companies. So we're not saying that there is a uniform set of principles that is used to develop the IFRS for all of those countries. It might not meet all their needs because there will be some countries where their economic environment is peculiar and it will be different from others. So there will still be this gap that the IFRS will not be able to meet all their reporting needs. It's possible. So it's a drawback and can stand as a disadvantage of this conceptual framework. Another one is that it's not clear that the conceptual framework makes the task of preparing and implementing IFRS any easier. Because since now that we have set of principles, that means at every point in time when we want to develop standards, we need to follow through with this set of principles. We need to follow through with this set of principles. So the task of developing standards might not be any easier. The conceptual framework might not make it easier. That can also stand as a disadvantage. Another issue relating to this conceptual framework is the uses of this conceptual framework. or the purpose of this conceptual framework. And in determining the purpose or the use, we just
Yeah, we're with you, but the network just break.
okay, good. Okay, so we need to identify who are the sets of users. When we get the set of users, then we can know the purpose of the conceptual framework. And the very first people is the IASB. The IASB uses the conceptual framework to develop standards and also to review existing standard. That's what that's what the IASB will use the conceptual framework for, to develop new standards and to review existing standards. Not only that, the IASB will also use this conceptual framework for harmonization of international regulations. Don't forget, one of the objectives of the IASB is to harmonize international and national accounting regulations. And conceptual framework can help them with that. Harmonization is saying that, okay, let's make our standards similar. If you don't want to use IFRS, can our standard become similar? That's harmonization. So with the conceptual framework, they can achieve that. That, okay, if you don't want to use IFRS, can you use the conceptual framework to develop your own standard? So ultimately, you find out that they wouldn't have similar standards. If they are developing their standards from the same set of principles, they will have similar standards ultimately. So the IASB uses this conceptual framework for harmonization of the accounting regulations. It can also help national standard setting bodies to develop national standards. It can help preparers in applying IFRS to their financials. It can also help preparers to develop consistent accounting policies. When I say consistent accounting policies here, what I'm speaking to is the fact that accounting policy is how a company chooses to apply an IFRS. Every company, every management of every company must select accounting policy. And every item on the financial statement has an accounting policy. Every item on the financial statement has an accounting policy. So where the conceptual framework comes in is in a situation whereby we don't have an IFRS for an item because accounting policies are developed from IFRS. So if you don't have IFRS for an item, the conceptual framework can intervene in developing accounting policy. If you don't have IFRS that treat or that deal with an item. It can also help users to interpret and understand the financial statements. It can help auditors in forming an opinion on the financial statements. And also, it can help those who are interested in the work of the IASB to understand how accounting standards are developed. It can also help the interpretation committee to develop interpretations on IFRS. Okay, so those are the uses of this conceptual framework. Now, I've introduced you to conceptual framework. And don't ever forget that this conceptual framework are just sets of principles that is used to develop IFRS. So now, let's look at those set of principles. And don't forget that this conceptual framework that we want to discuss now is different from accounting standard. The conceptual framework is used in developing accounting standard. It is not the accounting standard. So if it now happens that there is a conflict between the conceptual framework and the accounting standard, it will be the accounting standard that will override. If there happens to be a conflict, though we don't expect that, we hardly have that, but if it should happen, if you have a situation where there is a conflict, the IFRS will supersede. Okay, so I've been speaking for almost 30 minutes. Yeah, 30 minutes. Just to be sure that you are following, let's look at this set of quizzes together. So, quiz one, which of the following best describes a conceptual framework? What's the answer? Answer is A, statement of gap. Okay, so Shidima said accounting principles. Yes, it looks like that, but it's beyond just accounting principle. There are set of principles, both accounting and even beyond accounting. So we see them more like a statement of gap itself, a statement of gap, rather than just accounting principles, because they are set of principles. Number two, when there is a conflict between an accounting standard and a conceptual framework, which one will override? When there is a conflict between accounting standard, that's
Accounting
correct.
standard.
That's correct. Number three, the conceptual framework can help in the treatment of unusual transactions. True or false?
True.
That's correct.
It's true.
Number four, which of the following is not a purpose of the ISB conceptual framework? Which of the following is to assist preparation, assist auditors, authoritative? What do you think the answer should be?
So we're not seeing the options, so I can't see the options. So I think D.
Yes, the answer is D. That's really one that is not, because it helps the ISB, it helps the auditors, it helps in the treatment of unusual transactions. This is not the one. Okay, please show that you are following. So let's move to the content now. So this conceptual framework we are looking at now is a replacement of the 2010 conceptual framework. So this is 2018 conceptual framework. This conceptual framework was developed in 2018. And when it came in 2018, it came with a lot of updates. Like they changed the definition of elements of financial statements. They changed the guidance on recognition and derecognition. They changed the guidance on measurement basis, and they introduced principles for disclosures and presentation in the financial statement. So this 2018 conceptual framework is organized into chapters. And don't forget, these chapters will contain the set of principles I'm talking about. There are 8 chapters. And chapter 1 talks about the objective of general purpose financial reporting. Chapter 2 talks about qualitative characteristics of useful financial information. Chapter 3 talks about financial statements and the reporting entity. Chapter 4 talks about the elements of financial statements. Chapter 5 talks about recognition and derecognition. Chapter 6 talks about measurement. Chapter 7 talks about presentation and disclosure. Chapter 8 talks about concept of capital and capital maintenance. So as soon as we are done with this 8 set of principles, then can assure you we are done for this class tonight. The first set of principles, which we call chapter 1, that deals with the objective of general purpose financial reporting. And when we talk about a general purpose financial reporting, it is general purpose because this is a financial report that will be used by multiple users. It's a single report and will be used by many people, many users. So what is the objective of these reports? It says that the objective is to provide financial information. To provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. To provide financial information. That's the first sentence in this objective. So in your exam, you will not find ICAN asking you what is the objective of financial reporting. In fact, they will give you this objective and they will ask you questions from it. So we say that the objective is to provide financial information. And the question becomes, which financial information are we providing to users? What financial information? Even without me telling you, some of you might be thinking that this financial information are the statement of profit or loss, the statement of financial position, the statement of cash flows. You'll be wrong if you are thinking in that direction, because that is not the financial information. That is just the medium in which those information are communicated, or the statements that contains those information. So what is the financial information itself? The financial information are, according to the conceptual framework, say number one, they are economic resources of the entity, which is the assets of the entity. Number two is claims against the entity, which are the liabilities of the entity. And number three is changes in the economic resources and claims. Changes in the economic resources is like changes in your assets and changes in your liabilities. That's your income and expenses. And that is the financial information that is provided to users. You see this information, the conceptual framework says that this information should be prepared using an accrual basis of accounting. That's the principle on which we'll prepare all this information. That means everything, all the standard you have been learning and the one I will start teaching you very soon, they are based on accrual basis of accounting. And if I should ask you accrual basis of accounting, I'm sure you will tell me that this means that all income should be recognized when they are earned and not when they are received. And all expenses should be recognized when they are incurred and not when they are paid. It is beyond that, because accrual basis accounting is talking about when you are recognizing your assets, your liabilities, your income and expenses, you should recognize them when the transactions originating them occur. recognize asset, liabilities, income, and expenses when they occur, when the transaction occur. So accrual basis accounting is saying that as soon as the transaction originating asset is consummated, recognize it in your books. It's not until cash, there is a change in cash flow. No, as soon as the transaction is consummated, recognize it in your books. As soon as you have originated a liability, not necessarily when you collect money, as soon as you have originated a liability, recognize it in your books. As soon as you have worked for the money, as soon as you have met the requirement of IFRS 15, recognize income, recognize revenue, like that. So that's accrual basis of accounting. And most of the concepts and principles we will learn are based on this principle of accrual basis of accounting. Okay, that's the first part of this objective. This financial information, we are providing it about a reporting entity. We are providing it about a reporting entity. Well, I'm going to talk about reporting entity in chapter 3, but I mean, a reporting entity, just see that as a company, right, for now. So that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entities. Okay, so they said that is useful to these three set of people: investors, lenders, and other creditors, both existing and potential. This conceptual framework, this principle here, was very specific in regards to those we are supposed to present these reports to. He said just three people: investors. I mean, you should understand investors as shareholders, right? Lenders. You should understand lenders as maybe bankers or any high net worth individual that grants you a loan, right? These are our lenders. And other creditors, these are our suppliers. So this conceptual framework is saying these are the three sets of people that we want the report to be useful to. We don't care about those other users because there are other users like the government, like the general public, like the tax authority, the employees, the international community. They're also users. But the conceptual framework is focusing on these guys. And why? The reason is not far-fetched. These are the people that give us money. These are the people that ensure our survival. Without an investor, there is no business. Without lenders, without creditors, we can't run, we can't operate. So they are the providers of risk capital. So I kind of asked you guys before that they gave you this objective and they ask you that you should state the primary users of financial reports and their information need. So what they were expecting as primary users are potential and existing investors, lenders, and other creditors. And their information need. What do they need this information for? What decision do they want to make? Of course, the information is to make decision. So what decision do an investor want to make? So somebody might tell me that, okay, the decision he wants to make is whether the company is profitable or not. No, that's not the decision he's making. He's not the one making that decision. The company is profitable or is there in the report, in the information is already there. So he doesn't need to make that decision again. He is there. He just needs to look at the report and he sees it, whether the company is profitable or not. So, but the decision he wants to make, number one, he wants to make decision, the investor now, on whether he should buy additional shares of the company or whether he should sell the shares of the company. And why is the investor making this decision? It's because of the information he has. If the company is doing well, he will buy more of their shares. He will invest more in them. If they are not doing well, he will sell. That, okay, I can't be with these people anymore. The same thing applies to the lenders. The lenders will also make decision on whether they should provide additional loans to this company or whether they should even recover the one they have given them earlier. All depends on their performance, on the information they have. Also is the other creditors. The other creditors will also be making decision on whether they should provide trade credit to the entity. Should they give them more credits? Should they give them discount? All depends on the information that they have, right? Because the creditor will be seeing that, okay, this company is doing a lot of sales and they are paying early. They have money, they are liquid. They will see it in the information. So from that information, then they will make all the decision that they need to make. Okay, so that's the chapter 1 of the conceptual framework. Just to be sure that you're following, let's look at this set of quizzes. Let's look at this set of quizzes. Can somebody read this? Somebody should read this first one. Number 1, the conceptual framework makes it clear that financial information should be prepared using A, cash accounting, B, accrual accounting, C, all of the above. Accrual accounting. Number 2, which of the following is a financial information provided by an entity according to the conceptual framework? A, statement of financial position. B, statement of profit or loss and other comprehensive income. C, claims against the entity. D, all of the above. The answer is C, claims against the entity. Number 3, which of the following is a user of financial information according to the conceptual framework? A, government. B, lenders. C, employees. D, tax authorities. Lenders. Okay, so that's chapter 1 of the conceptual framework. Now, let's go to chapter 2, which is the second principle. And this chapter 2 talks about the qualitative characteristics of useful financial information. Qualitative characteristics of useful financial information. Now, these qualitative characteristics is talking about the attributes that a financial information must have for it to be a useful financial information. And these attributes, the conceptual framework distinguish these qualities into fundamental and enhancing. Into fundamental and enhancing. The fundamental qualitative characteristics is the one that distinguish a useful financial information from an information that is not useful or misleading. So it is the fundamental characteristics that makes the financial information useful. So when you have a financial information that does not have these fundamental characteristics, that means that financial information is not useful. The enhancing, those ones make the information more useful or less useful. The enhancing makes the information more useful or less useful. Now, the fundamental qualitative characteristics, there are two of them. There are two fundamental characteristics. There is relevance and there is faithful representation. There is relevance and there is faithful representation. Now, relevance, which is a fundamental characteristics, this means that the financial information must be capable of making a difference in the decision made by users. It means that the financial information must be capable of making a difference in the decisions made by users. And when we say capable of making a difference, it means that that information must have predictive value and confirmatory value. Predictive value in the sense that we should be able to use it to make predictions. We should be able to say that this company would improve their profit by so percentage. We should be able to say that this company will become a global company in the next few years. We should be able to use it to make predictions. And it should be able to confirm our past predictions. So that is what makes it make a difference. And when it is making a difference, then it is relevant. So it must have predictive value and it must have confirmatory value. So it is possible for ICAN to ask you that what are the items in the financial statement that makes it have predictive value? What are the items in the financial statement that makes it have predictive value? There are a lot of them. Number one is comparative figures or comparative values. So when you see a financial report, you will see that for every current year, they will give us the information of the preceding period, right? That enhances predictive value. It gives the information predictive value because when you see the revenue and the expenses of last year, and you see that of the current year, then you can predict. When they give you historical, you can predict into the future. Another information in the report that can make the information have predictive value is providing information on discontinued operations. When an entity provides information on its discontinued operations, it enables predictability because discontinued operation means that when you plan to discontinue a segment or a branch of your entity, IFRS 5 requires that you disclose, you present that segment separately and call it discontinued operations. When you do that, it enables people to be able to predict. People are already prepared. So when GSK left last year, a lot of people were surprised. But when you go and check their report since 2017, they have already been disclosing discontinued operations. They had been shutting down segments gradually. Predictive value. Another item in the report that can help or make the information have predictive value is providing information on non-current assets held for sale. So when an entity has an asset, a non-current asset, that it is supposed to be using within its organization, that is supposed to be using for its own operation, he now says, or he now changes its mind that he wants to sell it. That type of asset, we start calling it non-current asset held for sale. You need to present it separately. When that is presented separately, it gives the report predictive value. Another one is diluted EPS. IS 33 requires entities that are listed to provide information on their basic and diluted EPS. Diluted EPS is talking about that, okay, there are some potential ordinary shares that will become ordinary share in the future. And when they become ordinary share in the future, this is what our EPS will look like. This is what it will dilute to. This is what it will reduce to. That is diluted EPS. Of course, when you provide that kind of information today, users can easily predict. They know what their earnings is going to look like in the near future. And I can go on and on. So you need, they can, I have not really seen something like that in an ICAN exam, but they can ask you that what information, what item in an historical report makes that report have predictive value. And of course, for confirmatory value, that one is really not, it should be able to confirm your past prediction. This is just saying that the company should continue to operate as a going concern. The company or the entity should not shut down. So when they make predictions, you should be there. In the future, when they want to confirm it, it should have confirmatory value. They should be able to confirm their past prediction. Okay, that's relevance. I intentionally took a lot of time explaining this predictive value to you because ICANN has not really tested this area and they can test it. So when it comes to relevance, relevance is majorly affected by the nature of an item and the materiality of an item. It's not all items in the reports that are relevant. It depends on the nature. There are some items that is just there for descriptive purposes, but there are some items that are key, and especially materiality. There are some items in the report that are just, even if they omit it, it won't affect anything because they are not material. Because an item is material if you omit or misstate, it's going to influence decision that user make. That is it is those items that affect relevance. So relevance is affected majorly by the nature of the item and the materiality of that item. The second fundamental characteristics is faithful representation. Now, faithful representation is saying that, first, that a report is an economic phenomena in words and number. A report represents an economic phenomena in words and number. So it's just a description of your economic activities. That's what we mean by economic phenomena. A description of your economic activities, your trading activities, right? In words and numbers. And faithful representation means that you must faithfully present. You must present those phenomena that it purports to represent. You must present it. Let that your report present the phenomena they purport to represent. Meaning that if your revenue is 20 million, present that 20 million. Don't present 30 million. When your economic phenomena is 20 million, when your economic activity is saying 20 million, you are presenting, as an accountant, you are presenting 20, you're presenting 30 million. No, faithfully represent. So we expect you to be faithful, right? So for us to be sure that you're faithful, because we know most people will not, we are now saying that to be a faithful representation, right? The information must be complete, must be neutral, it must be free from error. Complete here means that your information, your report, must include all information necessary for a user to understand the phenomenon. It must include all information necessary for a user to understand the phenomenon being depicted. Every of your economic activity must be presented. It must be the one you cannot present in figures. Describe it, explain it in words. Complete. Don't omit. As soon as you omit an item, it will seriously affect your financial statement. That means it is not useful. So complete is key as far as reporting is concerned. Now, the second one is neutral. The information must be neutral, meaning that it must be without bias. So don't have a mindset when you are preparing your reports. Because when you have a mindset, then you would manipulate the report. Don't prepare your information that you want to wow your investors, you want to shock the markets. No, it is not the duty of accountants or financial reporters to do that. What we do as accountants is just to present the economic phenomena. It's just to present the economic activity of the company. That is all accountants do. It is now left to the marketers, to the operational people to wow whoever they want to wow. We is whatever it is that is their sales, we record it. Expenses, we record it. So neutrality, if you're neutral, then there's no way you can faithfully represent. And when we are talking about neutrality, they introduced prudence. So neutrality is supported by the exercise of prudence. Prudence was introduced, the concept or principle of prudence that talks about we need to be cautious when we are making judgments, because IFRS, you'll be making a lot of judgments. So you need to exercise prudence, which is to be cautious. And what that simply means is that don't overstate or understate your assets, liabilities, income, or expenses. Don't overstate or understate them. And as we move on, you will see that a lot of IFRS has already incorporated prudence and these principles we are talking about, just to ensure that we do not overstate our assets. Like I'm going to teach you the principle of impairment of financial assets. The whole idea of that impairment of financial assets is resting on prudence. It's just so that you don't overstate your financial assets, just so that you don't overstate your interest income from that financial asset. That is what that impairment represents. So prudence keeps us in check. It's a principle that is strongly used when developing IFRS. So that's neutral. Then thirdly is free from error. To faithfully represent, the information must be free from error. And free from error here does not mean that the information should be accurate or should be an exact or should be an exact depiction. See, the reality is that IFRS will make use of a lot of estimate and judgment. So our figures are not accurate. So what free from error is talking about here is saying that the description of your economic phenomena, the description of the phenomena must be free from error. So when you're describing your economic activities in your report, don't make it error-free. Also, the process by which the financial information is produced when you are passing your double entry, when you are classifying transactions, classify them properly. Don't make errors. That's what free from error is talking about. Description of your economic activity and also the process in which those figures are calculated or those financial statements are produced, they must be free from error. That's free from error. Okay, so that's faithful representation. Be faithful when you're presenting your figure. So they must be complete, neutral, and free from error. And there's a terminology we need to mention here, which is measurement uncertainty, right? Remember, I've been saying that IFRS is principle-based. We make use of judgments. We make use of estimates. So, and I've also mentioned not so long ago that our figures are not accurate. Okay. So the fact that our figures are not accurate, we call that measurement uncertainty, that our figures are not accurate. So there is always a level of measurement uncertainty in the report. So speaking about measurement uncertainty, IS1 requires that all entities must disclose level of measurement uncertainty. They must disclose areas where they have made estimates and judgments. Disclose it. You need to tell us that in these areas, I estimated. I wasn't sure. I estimated. When you check most comprehensive financials, you see it, there is a requirement of IAS1. So, you see, this measurement uncertainty, it can affect faithful representation because the level of your estimates must not be too high. Don't make estimates with no basis. Even if you are making estimate, there should be a basis for it. Because if your measurement uncertainty level is high, your financial statement will not be useful because it's going to affect faithful representation. So this is a way of keeping us in check, that our judgment must be reasonable and within the principles mentioned. Also, is something we call substance over form. I want to believe most of you here will have heard of the term substance over form before. So to further your knowledge, substance over form is fully represented as economic substance over legal form. That's the full representation of substance over form. Economic substance over legal form. There are two phrases here. Economic substance and there is legal form. So when we say economic substance over legal form, what we are saying here is that the substance is what financial reporting is based on. That reporting is based on economic substance and not the legal form. But the reality is this: in most instances, economic substance and legal form are mostly the same in most cases. But in few cases where the substance is different from the form, accountants go with the economic substance. So what does economic substance mean? It means that you should recognize the economic and financial reality of a transaction. That's economic substance. Economic and financial reality, not legal form. So economic and financial reality, we expect it should also be the legal form. That should what if there's any document backing those economic reality up, they should align. But there are instances where they don't align. For example, in a lease arrangement, you find out that the economic substance is different from the legal form. Because in a lease arrangement, there is a tenant or a lessee that is using an asset, that is using it to make money. And there is, on the other hand, the owner or the lessor that owns the asset, that is just collecting rent. He owns it. So for us accountants, if we walk into the company of that lessee and we see an asset, and we see that he's using it in production, we don't even need to ask. We will put it in his books as if the asset in his own, as if that asset is his own. So even if he tells us that, I lease this asset, it's still going to be recognized as a right of use asset, because the economic substance, the economic reality, the financial reality is that this asset is making money for this person. So it's his asset. Or another example is where you sold goods to somebody, or you sold an asset. You should recognize sales. But when you now have a situation where you sold goods and you're now telling the person you sold it to that you buy it back at a fixed price, that means you cannot recognize sales in that case because you have not sold. Because you say you want to buy it back at a fixed price. Why are you saying a fixed price? That means there is a mindset. That means that fixed price is not reliable. It's not the realistic value. For you to want to buy it at a fixed price, that means there is more to that transaction than meets the eye. So for us, we will say the reality here is that most likely maybe you need money. You just gave the asset to the person as a collateral, and the money he gave to you is a loan. So when you sell an asset and you have an option to buy it back at a fixed price, you don't recognize such sales as sales because you haven't sold. As we move on, you'll be seeing how reporting focuses on economic reality, economic substance, and not legal form. So why I'm talking about substance over form is that is implied in faithful representation. There is no way you can be neutral or you can recognize your information completely if your financial information is not presented in accordance with the substance and not the legal form. Like the guy that leased an asset now, if he now omits that asset from his books, he did not recognize it as an asset. That means that report is not complete. He hasn't recognized all the economic phenomena because you are saying you make money, you are making money, but we'll ask you, what is this thing that is making this money for you? It's an asset. Where is it? We want to see it in your books. So economic substance over form is a bedrock, is implied in faithful representation. Okay. Now, that's the fundamental characteristics. There is the enhancing characteristics. This one, they make it more useful or less useful. So even if a report does not meet these characteristics, it doesn't mean it's not useful. It's still useful, but I mean, it could be more useful if it has these characteristics. And what are they? Number one is comparability. So your reports should be capable of being compared with that of other entities. We should be able to compare reports with that of other entities, and we should be able to compare your report with that of your previous years. Okay? And the only way this is possible is to ensure that you treat all items in your books consistently and ensure that accounting policies are appropriately disclosed. This to aids comparability. Another one is verifiability. And this is saying that third parties, professionals need to be able to recalculate or recheck your figures. We must be able to recalculate or recheck your figures. You should be able to do that. That is what makes it verifiable. So the only way that can be done is that when you report in your account that, let's say you have a PPE, let's say PPE of 100 million, okay? It's only verifiable if you give us the breakdown of that 100 million. If you explain how that 100 million is determined, you tell us the component of it, then it becomes verifiable. We need to be able to recalculate and we check your figures. Then timeliness. The report or the information should be provided to users when they need it. If it is regulator you are presenting your report to, present it on time, meet regulatory deadlines. If you're a listed entity and you need to present your information to SEC before the end of the first quarter, make sure you do that before the end of the first quarter. If you want to present your report to FIRS before the end of 6 months, after the end of the reporting, after 6 months, before the end of 6 months after the reporting date, make sure you do that. Make sure the report is available on time. And finally is understandability. The report must be simple and concise for users. And note, users here, users we are referring to here are people who have reasonable knowledge of business and economic activity, and who is willing to review and analyze the information diligently. So users are those that have reasonable knowledge of business and economic activity. So even if you are an investor and you don't have business and accounting knowledge, you are not a user. From this perspective, from this context of understandability, we are not referring to you. We are referring to somebody that has reasonable knowledge of business and economic activity. So notably, there's something we call cost constraints. All of these qualitative characteristics I've mentioned here, is important that the benefits of providing information that meets these qualitative characteristics must outweigh the cost. The benefit must be more than the cost. Okay? If it is the other way around, then it's not compulsory you meet these qualitative characteristics. That's what the conceptual framework is saying. So ensure that the benefit of complying with these principles, the benefit outweighs the cost. Okay, so that's the end of chapter 2. Let's look at some quizzes together. Number 1 says comparability is identified as an enhancing qualitative characteristics in the IASB's Conceptual Framework for Financial Reporting? Which of the following does not improve comparability? Restating the financial statement of previous years when there has been a change in accounting policy. Yes, I will teach you this one in IAS 8. That when there is a change in accounting policy, you need to restate the financial statement of previous years. I'll teach you how to do that because it improves comparability. Number 2, prohibiting changes of accounting policy unless required by an IFRS. Yes, because accounting policy, when it is selected, it must be consistently applied. It's not something you change, right? Consistency is very important. So prohibiting changes in accounting policy, yes, it improves comparability. Number 3, disclosing discontinued operations in the financial statements. Yes, when you disclose discontinued operations, it improves comparability because you're already telling us that, okay, this information of this year and last year are different too, because we are going to be discontinuing some segments from this year. We'll discontinue. So that you will know that last year information, those segments that I'm discontinuing this year now, they are included in that one. So don't go and be comparing and be saying that this company is not doing well. So disclosing discontinued operation helps improve comparability. It helps improve it. So that means this D is the answer. Applying an entity's current accounting policy to a transaction which an entity has not engaged in before. Nope, that's not necessary because you don't need to apply your current accounting policy to a transaction you have not engaged in before. It doesn't improve, even though if you do that, it doesn't improve comparability because this is a new transaction. You are not really comparing it with any previous year. There is no even previous year because it's a new transaction that you have not engaged in before. So it's really D that does not improve comparability here. Okay. Question 2. Faithful representation is a fundamental characteristics of useful information within the IASB's Conceptual Framework for Financial Reporting. Which of the following accounting treatments correctly applies the principle of faithful representation? A, reporting a transaction based on its legal status rather than its economic substance. Reporting a transaction based on its legal status rather than its economic substance. So this one does not correctly apply faithful representation because remember, I just taught you substance over form, but this one is saying reporting based on legal over substance. That's the opposite of faithful representation. So this does not, so this is not the answer. Number 2, excluding a subsidiary from consolidation because its activities are not compatible with those of the rest of the group. This is also wrong. You cannot exclude a subsidiary from consolidation because its activities are not compatible. No. According to IFRS 10, the only reason why you can exclude a subsidiary is when that subsidiary is sold, or maybe you have lost control of that subsidiary. Majorly, you have lost control of it. Otherwise, it must be included in the consolidation process. So this does not apply the principle of faithful representation because your report will not be complete. The next one is recording the whole of the net proceeds from the issue of a loan note, which is potentially convertible to equity shares as a debt. So I think Shidima said C. It's not C, because when you have a loan note which is potentially convertible to equity. So I will teach you this in IFRS 9, that when you have a convertible loan, you would have to separate that loan into primary loan, into loan or debt, and also equity, because it's convertible to equity. So you cannot now record the whole of the loan as loan. You cannot, that's wrong. You cannot record everything as debt or liability. You're not faithfully representing. You will see, when we get to IFRS 9, I'll teach you this. So D is the answer. Allocating part of the sales process of a motor vehicle to interest, even though it was sold with 0% interest. So, this is saying that when you sell on credits and the credit period is extended, we see that as that you are giving a loan to that person. When you sell on credit for an extended period, so you need to separate that sales proceeds. You recognize a portion as interest. You recognize a portion there as interest. So D is the answer here. Number 3, financial statements represent transactions in words and numbers. To be useful, financial information must represent faithfully this transaction in terms of how they are reported. Which of the following accounting treatments would be an example of faithful representation? Okay, so I will give you opportunity again to answer, because I have few students in this class. I asked somebody to read the other time. Nobody attempted to read, right? If you do that, I don't know why you have paid so much money just to be in class and be sleeping. I really don't understand. When the lecturer is asking you a question, you are quiet, really don't understand. So that approach is not helpful to you. And I will not be happy. We will make a lot of effort. You are not passing these exams. Sure, most of you that are here knows that it takes great effort. And all of these things I'm teaching you, I'm sure by the time you get to the exam, or you will know that it's more important than group accounts. You would know, you will see. Probably when you start checking your past questions, better pay maximum attention to all of these principles, because this is CR in its very raw sense. So let me give you opportunity to participate again. Even though why I'm really reviewing these ones is I feel that they are a bit advanced now, because I've not actually taught you some of these standards yet, and these questions are very deep. So let me see if you can attempt this question 3. I said, which of the following accounting treatments would be an example of faithful representation? Any trial? Tough question. Okay, so let's look at it together. So which of the following would be an example of faithful representation? So so charging rental payments for an item of plant to the statement of profit or loss where the rental agreement meets the criteria for a finance lease. This is wrong. You cannot do that. I will teach you IFRS 16 and you will see that for finance leases, right, the rent that is received or paid is not expensed, is not recognized in P&L, is capitalized. So for the lessee, all the rent is paying, you capitalize it and call it right of use assets. For the lessor, all the rent is receiving, capitalizes it and call it net investment in the lease. So this is wrong. This is not faithful representation. You don't charge the rental payment to P&L. B, including a convertible loan note in equity on the basis that the holders are likely to choose equity option. This is similar to the one I explained in question 2. So when you have a convertible loan, IFRS 9 requires that such loan must be separated, must be bifurcated into equity and debt. So you cannot assume that the loan note holder will choose the equity option. No, you don't even know which option the loan holder would actually take. So convertible loans are recognized both as equity and debt, not just as equity. You are now assuming that, okay, the no longer will convert it to equity. So this is not also right. This is not faithful representation. Number 3, C, is the recognizing factor trade receivable sold without recourse. So a factored trade receivable is a trade receivable that is sold, that is transferred to a factor. So when you transfer a trade receivable to a factor and it is without recourse, which means that if the factor or if it happens that the factor cannot get back that money from the receivable or cannot recover the money from the receivable, it cannot come back to you. It cannot come back to you and say that, this agreement I have that I will go and help you collect your receivable. So I could not collect the money. So the money I gave you in advance or all the effort I've put, can you? No, it cannot work. It's without the cost. So in that sense, in that wise, you can go ahead and recognize it, such a trade receivable, because you have factored it without the cost. The factor cannot come back to you. So it's as good as you have sold that trade receivables. It's as good as you have collected your money from the trade receivables. You have transferred it to another party to go and pursue them. And the guy cannot come back to you. So you can recognize it. So this is correct. This is actually the answer. You see this fourth one, the reason why it's not the answer is that redeemable preference shares is a preference shares that the holder is going to collect back his money. Redeemable. Okay? So it cannot be equity. Equity is residual. Equity does not collect back their money. Equity are there with us forever. So treating redeemable preference shares as part of equity is not faithful representation. So the answer is C. Number 4. Okay, I think this one is straightforward. Which of the following is not a fundamental characteristic identified in the conceptual framework? A, faithful representation, B, relevance, C, materiality, D, reliability. What's the answer? Which of the following is not a fundamental characteristic? D, reliability. That's correct. The answer is reliability. Faithful representation is there. Relevance is there. Materiality, though not separate, but is affected by, is what affects relevance. So the answer is D. Number 5. In accordance with IASB's Conceptual Framework for Financial Reporting, which qualitative characteristics assumes that users have a reasonable knowledge of business and economic activity and willingness to study the information with reasonable diligence? Thank you. Understandability. That's your answer. Okay. See, all of these quizzes is just for the fact that yeah, saying see understand. Yeah, correct. All of these quizzes is just the fact that it's just a way of engaging you guys on this online class. So you have to participate. I just want to be sure that you are actually participating. That's why you see me, I will be putting in quizzes. In class, if I was teaching in physical classes, all these quizzes will not really come up because I can easily ask questions, students can communicate and all of that. But these virtual classes, we need to be sure that you're actually communicating by asking relevant and reasonable questions within what we are teaching. Now, let's go to chapter 3 of this conceptual framework. So this chapter 3 talks about financial statements and the reporting entity. Okay. So the first thing chapter 3 talks about is the objective and scope of financial statements, which is similar to what chapter 1 talked about. That the objective of financial statement is to provide information about assets, liabilities, income, and all of that. So it's similar. I won't really go through that again. Then secondly, it talks about reporting entity. What is a reporting entity? So it says that a reporting entity is an entity that is required or chooses to prepare financial statement. Because we understand that there are some entities that are required to, that is just compulsory that they must present financial statements. Why some just choose to? It's not like it's not compulsory. They just choose to. So all of them are reporting entity. And a reporting entity can be a single entity or a portion of an entity, or it can comprise more than one entity. So a reporting entity is a single entity, a portion of an entity, or more than one entity. And you know what a single entity is? Like Equity Professional Limited now is a single entity. Or let's say First Bank Limited is a single entity. And it could be a portion of a single entity. That's a branch or a segment of that entity. Like at Equity, we have VI Center, we have online activity like that. That's a portion. And over time, when I'm teaching you IFRS 8, I'll teach you how to report for a portion of a single entity, a portion of an entity. So a reporting entity can also comprise more than one entity. More than one entity. So I'm sure Mr. Abiodun will have taken you through group accounts, the starting part, and you must have been solving some questions that when an entity has subsidiaries, they must report their financials as that of a single entity. So when you have more than one entity, all of it put together, we see you as a reporting entity. This is obeying IAS. In fact, IAS 27 and IFRS 10 is obeying this principle here. So, and finally, is that a reporting entity is not necessarily a legal entity. It doesn't have to be a legal entity. It doesn't. So a reporting entity can be a sole proprietorship business. It can be a partnership business. It can be a company. So it's a company that is a legal entity. Those other ones, they are not. So a reporting entity does not have to be a legal entity, right? Also, chapter 3 talks about reporting period. which is looking at the period over which we provide financial statements, which is usually a period of 1 year, the current period. And also, reporting period also include providing comparative information, which is information of the prior year. And also, we expect that the current reporting period must, in some circumstances, provide forward-looking information. So it should be able to provide forward-looking information to us, right? Like having predictive value, like I explained critically when I was looking at chapter 2. So reporting period is just looking at the period for which the financial statement is presented, the current period, the previous period, and there's nothing wrong with the current period providing forward-looking information that will make user to be able to predict, right? So reporting period. And when we are presenting our financial statements, so we prepare financial statements from the perspective of the reporting entity. So financial statements are provided from the perspective of the reporting entity and not the investor. So that's the perspective on which financial statements are provided. And furthermore, when you present financial statements, we assume that the reporting entity will continue to operate into the foreseeable future. That's going concern assumption, right? So it's on this principle that financial statements are being reported and presented. And when where a reporting entity consists of more than one entity, then it is better to prepare a consolidated financial statement. Consolidated is more useful than unconsolidated. When an entity has more than one entity, when it has subsidiaries, consolidated is better than unconsolidated. Okay, so that's just what chapter 3 is speaking about. Chapter 4 talks about elements of financial statements. So what this principle here is speaking to is it details out the definition of the core element of financial statements. And you will, of course, have known, or if you don't, you will know that these 5 elements are the financial information that chapter 1 was talking about that we provide the users. So all the information in financials are around these 5 elements. So what chapter 4 does for us here is to define it. To understand the principle behind them. So looking at the first one that talks about assets, it says that an asset is a present economic resource controlled by the entity as a result of past events. A present economic resource controlled by the entity as a result of past events. So an asset here, firstly, is an economic resource. So what is an economic resource? It says an economic resource is a right that has the potential to produce economic benefits. A right that has the potential to produce economic benefits. So therefore, whatever you have that can produce economic benefit for you is an economic resource. And you see, when we say producing economic benefits, we are talking about ability to make money for you, ability to make savings for you, ability to reduce your liability, something that is beneficial to you economically. So when you have when you have such that you have right over it, it's likely that that thing is an asset. Whether you can see it or not is not what is important. But whatever it is that you have that produces economic benefits, that makes money for you, that makes savings for you, that reduces your liability, that is an economic resource. However, before you can call that economic resource your assets, it must be controlled by you. And control here means that the benefit from that resource must flow to you. The benefit from that resource must flow to you. And these resources must be as a result of past events. You must have acquired it. It's not something you are still planning to acquire or you are still planning to engage. No, it's something that must be as a result of past events. So whatever it is that is an economic resource that you have, it doesn't have to be something physical that is big that you see. So at your level, don't see an asset in that regard. It could be anything. What is important is it producing economic benefit? And this benefit, is it flowing to me? Is it flowing to you? Then that's an asset, whatever it is. I mean, if your company has a Facebook page and is generating money, you can use it to make marketing, is making you savings, it's an asset, it's an economic resource. Anything. Liability. Liability is a present obligation of the entity to transfer economic resource as a result of past event. A present obligation to transfer economic resource as a result of past events. The key word here again is obligation. When we say obligation, it's talking about a duty of an individual or of an entity to act in a certain manner, a duty to do something. And what makes it an obligation is not just that duty. Here, this obligation is a duty that you have no practical ability to avoid. You cannot avoid it. That is an obligation. If you can avoid it, that is not an obligation. You cannot avoid it. Then that is an obligation. So that duty in this context is to transfer economic resources, is to transfer what is making money for you, is to transfer economic resource as a result of past events. So when you have a duty that you cannot avoid and it entails you transferring economic resource, you have a liability, whatever it is. When you have a duty that you have no choice but to transfer economic resource, that is a liability, whatever it is. I mean, these definitions are principle-based. They are principle. And the whole idea of accounting is around this definition. Because when you understand this definition, you know when to recognize a liability. It's not about when money leaves. I mean, this definition is what accrual basis is all about. The third one talks about equity, and it says that equity is the residual interest in the asset of an entity after deducting all its liabilities. Residual interest in the asset of an entity after deducting all its liabilities. So The key word here is residual interest. So let me bifurcate this residual interest. So let me leave residual for now. Let me look at interest in assets. So who has interest in an asset? They are the owners, they are the users, primary users like investors, lenders, creditors. They are the people that has interest in your asset. And when I say interest in your asset, it means that whatever money that asset is making, the returns will definitely go to them, right? So they have interest in assets. So out of these people I've mentioned, people like lenders, their interest is preferential. Any money you make, you pay them first. Your creditors, their interest is preferential. Any money you make, you immediately go and settle your debts. The goods you bought for them, you need to pay up. Their interest is preferential. However, the investors, who are the shareholders, there are some of them that their interest is preferential, that they will have made an agreement with you that whenever you make profit, you must pay us dividend. Those ones are not equity. Equity is a residual interest. They are investors that does not get returns until all other stakeholders have been settled. Until all other stakeholders have been settled. They are residual. They come last. And that's equity. So when you have investors whose interest is residual, then that's an equity holder. So generally, over time, experience has shown that ordinary share capital are equity holders. Those are the people we call equity. And of course, the reserves of the company belongs to the ordinary shares because that is what is left after we have settled all stakeholders, reserves. So ordinary share capital plus our reserves is our equity. The next is income. So income is an increase in assets, decrease in liabilities that result in increase in equity, other than those relating to contributions from holders of equity claims. So the first thing here is increase in assets. So when your asset increases, that is an income. An increase in asset could be sales. I mean, when you use your assets, it generates sales. It will increase because you're going to make money. Increase in assets. More money is coming in, right? An increase in assets could be as a result of revaluation of that asset. It's an increase in asset too. So income and revenue are not the same. Revenue is just a subset of income. Income is way bigger than revenue. In fact, revenue is just part of increase in assets. We have not even gone to decrease in liability and increase in equity. So income is huge. It's bigger than revenue. Don't ever mistake income and revenue. They are not the same thing. They are not. Income is big. So income is increase in assets, which includes revenue and some other income like revaluation gain and some remeasurement gains. Also, income is a decrease in liability. If your liability should decrease, not because you settled, but for other reasons, like maybe they forgive you the liability, or maybe they remeasured the liability and the value now decreased, or maybe they gave you discount. Those are decrease in liabilities is an income. And it's going to result in increase in equity. Remember, I told you that equity is ordinary share capital and reserves. So when your equity should increase, we are not talking about the increase in share capital. That's why this definition says that other than those relating to contributions from holders of equity claim, other than those relating to contributions from holders of equity. So we're not talking about contributions from holders of equity claim here. The increase in equity we are talking about here is profits. Profits. The increase in your reserves. Profits. Finally is expense. So expense is like the opposite of income. If you look at it, expense is a decrease in assets, increase in liabilities that results in decrease in equity, other than those relating to distributions to holders of equity claim. So this decrease in equity here is not dividend. That's why they said other than those relating to distributions to holders of equity claim. We are not talking about dividend here. That is not what we are talking about. What we're talking about here is losses. Losses. Okay. So those are expenses. So this definition, very principle based, they are principles. And there is no transaction that this definition will not help you decipher. If you understand them, you understand a lot of issues. So most of what I've explained are here. Let me see if you were following though. Let me ask you some questions. So quizzes. Number one, in accordance with the IASB's Conceptual Framework for Financial Reporting, what is the definition of income? What is the definition of income? Okay, the answer is C. Increase in assets, decrease in liabilities that result in increase in equity, other than those relating to contributions from equity participants. The answer is C. Number two, when a PLC has purchased the patent for 20,000, the patent gives the company sole use of a particular manufacturing process, which will save 3,000 a year for the next 5 years. What element of financial statement is this patent? Let me allow you to try this one. Who is trying this one? What element of financial statements? Okay. Assets. It is not an asset. Anyway, he's an asset. That's correct. So he's going to save you 3,000 a year. So it's an asset. Number three, Ade Limited paid, we say, about 10,000 to set up a car repair shop on condition that priority treatment is given to cars from Ade. What element of financial statement is this 10,000 naira to Ade? So what's this one now? Liability. Somebody saw liability. It is not liability. We are talking about to Ade. Ade, how can somebody, Ade paid somebody? He's not having a liability again. How is that an obligation? It's far from a liability. Equity. So, I mean, that's still close to it because he paid him to set up a shop. So he looks as if he's investing. So, and when you invest in somebody, so you might say you have a residual interest, but you would improve with that later. You get to know that if this is an investment, then it's not equity to Ade. It is an asset from Ade's perspective because he has invested. It is Wise Baba, okay, that they invested in that will be calling this money equity, but that's not even the answer. The answer here is an expense. Okay, so it should be between assets and expense, but the answer is expense because Ade Limited paid, we said 10,000 to set up a repair shop. Okay, so this will have been an asset to Ade if Ade has control over that shop, because an asset is an economic resource controlled. So he paid him to set up, and it's not like he wants to be a part owner or something like that. It's not an investment. All he just wants is that whenever he comes to wash his car, they should give him priority treatment. He's not even saying he won't pay, he will pay, but they should just give him priority treatment. So it's not assets, and it's far from liability, it's far from income, it's not equity, it's expense. It's just a decrease in his assets. That's all it is. A decrease in his assets. He has just given a gift. He has given Ade a gift. Sorry, he has given Wise Baba a gift. It's an expense from the perspective of Ade. Number 4, Truthful Limited provides a warranty with every car sold. What element of financial statement is the warranty? A, assets, B, liability, C, income, D, equity, E, expense. Correct, liability. Okay. So chapter 5 talks about recognition, recognition and derecognition. So recognition is the process of capturing for inclusion in the statement of financial position or in the statement of profit or loss and other comprehensive income, an item that meets the definition of one of the elements of financial statements: assets, liabilities, equity, income, expense. So recognition is just the appropriate way of saying recording. So it's the process of including in the statements an item that meets the definition of the elements. So any transaction, any item that meets the definition of any of these elements, go ahead and include it in your financials. That's accrual basis, and that is recognition. When they meet the definition, recognize them, include them. That's recognition. Okay, so the criteria for recognizing elements into the financial statement is that they have met the definition. The definition I mentioned in chapter 4. Additionally, an asset or liability should be recognized if they are relevant and they will be faithfully represented. Relevant, faithful representation. Therefore, if an examiner asks you recognition criteria for items in the financial statement, number one is that, number one, the item must meet the definition of elements. Number two, that item must be relevant and must be it must be a faithful representation of the transaction. Those are the recognition criteria. On the flip side is derecognition. So derecognition is the removal of an item from either the statement of profit or loss or the statement of financial position, and you remove them when they no longer meet the definition of either an asset or a liabilities, as the case may be. When they no longer meet the definition, you remove them, you derecognize them. And we're going to be using a lot of these words, recognition, derecognition, as we move ahead in our studies, which you're going to see. So the conceptual framework considers the recognition to be a factor when either there is a loss of control, okay, in the case of an asset. So when you have an asset and you have lost control, you need to derecognize it. Or when you have a liability and you no longer have an obligation, you need to derecognize it as well. Derecognize it from your books. So that's recognition and derecognition. Recognition and derecognition. Now, chapter 6. This talks about measurement. So these elements, asset, liabilities, income, expenses, and equity, when they are recognized in the financial statements, they are recognized as in monetary terms. Okay. These monetary terms, that's what we call measurements. So in reporting, we have measurement basis. Okay, we have different measurement bases. So you need to select which measurement basis you want to use. And there are two of them, just two, that we're going to that we are going to be faced with in reporting. Number one is historical costs. Number two is current value. So historical costs is the price you paid for an asset or for the event, the price you paid for an event that gave rise to the liability. So that's historical costs, the price paid for an asset or the price for a liability. Historical cost does not change in your books. It doesn't change. From the date it is originated till the date it is derecognized, it doesn't change. It will be the same. And is so popular even till today. As soon as you recognize your asset or liability at historical cost, if your measurement basis is historical cost, it doesn't change. That's the value it will be for a very long time. Then there is current value. So this is a new one in the sense that it's also historical costs. I mean, it's the price paid for an asset or liability, but this is usually updated to reflect any changes since it was acquired or incurred. So current value is just a price that you pay, but you update it. It's just like you bought a car 5 years ago. While historical costs will leave the cost as it is, the price at which you bought it that 5 years ago in your books, current value will update it to the current price right now. That's current value. It updates so that it can reflect the current reality in the economic environment. So when updating, you don't just update. There has to be a context to it. So there are three main bases for current value. There are three. Is either your current value is your fair value, or is your value in use, or is your current cost. So if the context is that you want to sell an asset, then you are going to update that cost, that historical cost, you're going to update it to fair value, which is the price you want to sell that asset or you want to settle that liability. If the context is that you want to sell, you want to exit, then we're going to be speaking about fair value. But if the context is that you are still using the assets, you just want to know the value today, you are still using it. That's where things like evaluation comes in. And in determining the value, the process uses is value in use. You would determine, okay, if I continue to use this asset for 10 years, what value will I get from this asset over 10 years? So it's like they will project future cash flows and discount it to present value. And this context is used when you want to continue to use an asset, but you want to know, okay, what's the value today? And the value today is based on the perspective of the income generating ability of that asset. Value in use. And current cost is where you want to replace that asset with a new one. Current cost is what's the cost of that new one today. That's the replacement cost. So as you study IFRS, you are going to be meeting most of these measurement bases, and we're going to apply them appropriately. And all the measurement bases we are going to learn in this course is never going to be outside of historical cost or current value. And current value is either fair value, value in use, or current cost. Okay. So I have some quizzes here. So this one says, in accordance with ISB's conceptual framework, which of the following is not a measurement basis? Current cost is a measurement basis, value in use. It's present value. Present value is not a measurement basis. Which of the following criticism does not apply to historical cost? They are difficult to verify. No, historical cost is not difficult to verify. A is the answer without even looking further. A is not, historical cost is not easy to verify. It's not difficult to verify. Very easy, because the value does not change. It doesn't change. It's unlike the current value that you update depending on the context. This one does not change. So A is just the answer. So this one, historical cost is a mixed value, yes, depending on where you buy it. Because if you buy today and you want to use historical cost, it's the value today. And you're going to mix it with those ones you have bought 10 years ago. So historical cost is a mixed value. Historical cost will understate your asset, yes. It will understate because the value does not change. Even now in Nigeria, where all prices are going up, historical cost will not change. It's still the same. And of course, when you understate your asset, you overstate your gearing because your asset is suppressed. So liabilities will now be higher. Liabilities will be higher. So it's like you're going to suppress your gearing. Okay. Now, this chapter 7, the focus of this one is these elements we are talking about. It has to be presented properly. There are some principles they mentioned here that when you're presenting this information, these elements, don't offset. You don't allow offsetting. Don't avoid unnecessary details and avoid a standardized approach. We are going to apply most of these principles as we move on. So later, but the core of what this chapter 7 is looking at, first, he clarified that, yes, income and expenses are included in P&L. However, there are certain income that we don't want you to put in P&L. We put them in other comprehensive income. There are some income that we really want an entity to put in the other comprehensive income because their income arising from changes in current value of assets or liability. So when an income or expense is arising from change in value of an asset or liability, don't put such an income or expense in P&L because it's going to distort your profit. It's just like an asset you bought a few years ago for 20 million, today is now worth 50 million. I mean, to you, you have made a gain of 30 million. Don't put such a gain in P&L because that gain can reverse. What happens if the economic environment reawakens? If things should change? So we are very prudent. I mean, that's part of prudence. You don't put that kind of income in P&L, put it in OCI so that at least users will know that, okay, this income, they are unearned. We have not earned it. So, and there's another concept called recycling, which is saying that, okay, this income you put in that you put in OCI, if you now earn it, if it becomes earned, you can recycle it back to P&L. It's just like the example I gave you, an asset you bought a few years ago for 20 million and is now worth 50 million. That 30 million gain is unearned, but if you now sold the asset for 50 million, you collect 50 million cash. Of course, that 30 million, you have earned it. And then you can recycle that income to P&L because you can confidently say that, okay, this is an income that should go to your profits that are readily available for distributions to investors. So the final one is chapter 8 that talks about the concept of capital and capital maintenance. So two things here. The first is the concept of capital. The second is capital maintenance. So according to this conceptual framework, there are two concepts of capital. There is the financial concept of capital, and there is the physical concept of capital. You see, as it is in the accounting world today, most entities use financial concept of capital when preparing their financial statements. We use financial concept of capital. And you see, under a financial concept of capital, we see capital as the invested money or invested purchasing power. So capital is synonymous to net asset or equity. And that's the concept of capital adopted by most entities right now. So when you check capital, it's just the amount that is invested. It's not more than that. That's capital. But we are saying there's another concept of capital called physical concept of capital that you need to be aware of. Because capital is regarded as the productive capacity or operating capability of the entity based on, for example, unit of output per day. So the physical concept of capital sees capital as your productive capacity. It doesn't look at the money value. It looks at what that money can produce. It looks at the productive or operating capacity of that capital. That's physical concept. Unfortunately, this concept is not popular. Even though it's better, it's not popular. It's not used. And the reason is because it's a more complex way of reporting. Because that means, because people invest money. So for you to now get capital, you need to convert that money to production. It's a complex process. Which entities should use internally, but when preparing your report, you can use your normal financial. So for your exams, you need to know that these are the two concepts of capital. Now, The second thing is capital maintenance. So when have you maintained your capital financially? If you are using a financial concept of capital, when have you maintained your capital? If you are using a physical concept of capital, when have you maintained your capital? Very straightforward. And that's where profit comes in. You have maintained your capital when you make profits. As soon as you are making profits, you have maintained your capital. Even if you break even, you have maintained your capital. So for financial concept of capital, so you would have maintained your capital if your capital at the end is equal or higher than your capital at the beginning. For financial concept of capital, you have maintained your capital if your capital at the end is equal or higher than your capital at the beginning. Now I'm talking about money, the value, the nominal amount of the capital. But for physical concept of capital, you have maintained your capital if your productive capacity at the end is equal or higher than your productive capacity at the beginning. So this does not look at the money. This looks at what this money can produce. That's the physical. Look at this scenario now. So this company now, it has an inventory of 100 units. So the value is 500 naira at the beginning, which means that one of them is 5 naira per unit. So 500 naira. At the end, the 100 did not change. It's still 100. But look at the value now. It's 600, meaning maybe inflation. The price per one is now 6 naira, but the value is 600. Other asset did not change. So capital at the beginning is 500 plus 1,000, which is 15. Capital at the end is 600 plus 1,000, which is 16. This is a scenario, right? For financial will say that we have made a profit because our capital at the end is 16. Our capital at the beginning is 15. So we have made a profit of 100 naira. And you can even go ahead and distribute that 100 naira to shareholders. You will run into trouble. You will run into trouble. Because when you look at it physically, that extra 100 naira will just enable this guy to be able to sustain and be able to retain this 100. Because at the end, this 100 can be produced with 600 naira. The value is now 600 naira. So physical capital maintenance will say, guy, you're not making profits. You have really broken even because your productive capacity still remains the same. It's still 100 units. Yes, the value has gone up, but that's just inflation. This 600 can still produce only 100 units. So you have not made any profit. Okay. So that's chapter 8. And that's the end of all the principles we're talking about. So these are some questions that I kind of asked in the past. In 2021, when they just brought in this conceptual framework, I can asked about prudence because they just introduced prudence into that conceptual framework then. So they were asking you guys about prudence, and they were asking that you should define assets and liabilities, those new definitions. And they even want you to define the old. They won't ask, should not ask something like this again because now it has come to stay. So people are used to the new definition and we have forgotten the old definition. I don't even remember the old definitions again. They have also asked about where substance of a transaction may be different. I've built some solutions for you here. And there are some questions I actually built for you here that you can look at. So next week, we're going to be moving to chapter 3 of this handout. And that means next week we are starting accounting standards. And we're going to be on accounting standards all through the remaining, I think, for almost 12 weeks, I'll be teaching you accounting standards. And then the remaining 3 weeks, we'll do ratio, we'll do all those sustainability reporting and all of that. Okay, so let me release you guys for tonight. You have really tried. You have spent over 2 hours here in this class. So do you have any questions? Okay. Have a wonderful night. Bye.
Thank you. Good night, sir.